Insurance, love it or hate it, especially if you're from California, it's everywhere. Your house, your car, your phone, even your pets. But have you ever wondered how it actually works? Insurance companies promise to have your back when things go wrong, but they're also in the business of making money. So, how do they pull it off? Let's go. Basically, insurance is there to protect an individual or a business from financial loss. You make monthly payments, also known as premiums, to this company, and you should be protected should something bad happen, like your house burning down. Now, the risk is taken both ways. Let's say that you live in an area with a low chance of fire. It's low, but it's not zero, so you get fire insurance. You pay it for months, years, decades. You never have to deal with a fire, which, first of all, amazing. No one ever wants their stuff to be burned. But there's also, on the flip side, some people are like, why did I pay this fire insurance if nothing happened? Well, that's the risk you have to take. You pay it and nothing happens, amazing. You don't pay it, something happens, you're screwed. Likewise, for the hundreds of thousands of people who take out fire insurance, there's inevitably going to be some people who have to take out an insurance claim. Now, from the perspective of the insurance company, they want as few claims taken out as possible. Obviously, they want to keep all of those premiums as profit, right? But that's the risk that this insurance company takes. Insuring people for something that's very dangerous and hoping that they don't actually have to pay out, because inevitably there's going to be a massive fire or something that wipes out an entire neighborhood, and now this insurance company has to pay tens if not hundreds of millions of dollars. But that's the game they're in, so it's the risk that they take. Now, this principle applies to all types of insurance, whether it's auto, health, or life insurance, and there's more to this system than just premiums and payouts, so let's break it down. Now, premiums, this is the money that you pay monthly to the insurance company, and it can change depending on risk factors. So, how old are you? What's your driving history? Where do you live? Things like that, depending on the insurance. And now these risk factors can have a massive effect on how much you pay per month. So let's say you want fire insurance, and you live in an area that's prone for fires. Well, you're probably going to pay a higher risk premium than someone who lives on an island where there's going to be no fires. So deductibles, let's say that something happens and you have to take out a claim. Well, you actually have to cover some of the damages. So let's say your deductible is about $500 and the damage is $1,500. You pay for the first $500 and then the insurance covers the remaining $1,000. Now, coverage limits. Insurance policies also have caps on how much they're willing to pay. Let's say your policy limit is $50,000, but the damage is $80,000. Well, the insurance is going to cover the first $50,000 and now you're responsible with the excess, which is the $30,000. Now, risk pooling. Insurance works because it spreads out the risk. Let's say you have 100,000 people who've bought this insurance, and every year on average about 50 people will do an insurance claim. Well, it spreads out the risk and it spreads out the cost, and it makes it more manageable for everybody involved. Now, exclusions. Not everything is covered under a blanket of insurance. Let's say you have a home insurance policy. Well, many of them don't cover flood insurance. So if you live in a flood zone, you're most likely going to have to take out a separate policy for flood insurance. Insurance provides peace of mind, but it's also a business. While they'll be there for you in an emergency, they're also focused on profitability. So know what your deductibles are, know what your premiums are, what your limits are. It can give you a better understanding of your coverage, and also it could help you determine if it's the right coverage for you or it's not. Now, this is very important because in recent years, a lot of insurance companies are pulling out of areas or significantly reducing their coverage in areas that they deem risky. So this could be California, Florida, or basically the entire South. And this is affecting millions of people. This trend is creating a massive crisis for homeowners and businesses alike, as they try to scramble to find affordable insurance, or at least any coverage at all, for their specific areas. So it is in your best interest to shop around at these different insurance companies to see which ones have the better policies. Also, look at your current policy to see if it's covering everything you need it to. And while you're at it, look at mitigating risks at your home or your business, doing everything you can to make it as not risky as possible. So installing a fire-resistant roof or hurricane shutters at your house, anything you can. Remember, these companies are leaving these areas due to growing risk. So this might be the sign you need to actually leave if you have the financial means to, because inevitably there's probably going to be more issues coming in the future. So yeah, while many people complain about having to pay insurance, they're certainly glad when they have to use it. Unless the insurance company decides that your current situation doesn't meet their convoluted qualifications for a coverage, but that's another story. And with that, I'm Evan, and thanks for watching. If you liked what you just saw, then click on the video here. Also, if you haven't, like, subscribe, and hit the bell icon so you don't miss any future videos.